All right, let's get right into it. Today, we're talking about something that a ton of us do, but maybe don't really get mutual funds. We're going to break down the classic mistakes people make, look at the big choices you have to make, and hopefully give you a solid game plan for investing with a bit more confidence. So, does this hit close to home? You hear all the success stories online. You get excited, start a few systematic investment plans, and it feels awesome, right? But then the market takes a little dip, and suddenly that confidence just evaporates, and you're left feeling super uncertain. And look, if you've felt that way, the big takeaway here is that it's completely normal. So many investors hit this exact same wall. The real trick is figuring out why we feel that way, and then building a strategy that's strong enough to get you through those moments of panic. All right, so let's start with the absolute basics. What even is a mutual fund? At its core, it's just a way to pool money with a bunch of other people to buy a whole basket of stocks or bonds. Instant diversification. Simple, right? But what's kind of wild is how this one simple idea completely changed the game for regular investors. I mean, think about it. Before mutual funds came along, being truly diversified was something only the wealthy could really do. For the rest of us, not so much. And that's exactly why their growth has been absolutely explosive. We're talking from around $5.6 trillion in 2004 to nearly $20 trillion today. It's become the go-to engine for how most people save for retirement. Okay, so if these things are so great, why do so many of us mess it up? That brings us to part one. Let's walk through the most common traps that catch investors off guard. All right, trap number one, and it's a classic, chasing performance. You know what I'm talking about. You see a fund that went up like 50% last year, and your brain just screams, I need a piece of that. It is so tempting. But here's the thing. What went up yesterday isn't guaranteed to go up tomorrow. The smarter move is to look for consistency. Find funds that have a solid track record through all kinds of markets, the good and the bad. And the next big one? Trying to time the market. This is where you try to be a genius, right? You think you can sell right before a crash and then buy back in at the absolute bottom. Here's the hard truth. Pretty much nobody can do that reliably. It's basically impossible. Mutual funds are built for the long haul. The boring, but usually way more profitable strategy is just to stay the course. And this quote really nails why those two traps are so dangerous. When you're just frantically chasing the highest returns, you forget about your actual financial goals, and you often end up taking on way more risk than you ever needed to in the first place. So, if chasing returns is a bad idea, then what's the alternative? How should we be thinking about this? What are the actual big picture decisions we need to be making here? All right, that takes us right into part two. Let's shift gears from what not to do to the big strategic choices you need to make that will really shape your entire investment journey. Okay, the first huge choice you have to make is active versus passive. Think of it like this. An active fund has a manager, a real person, who's actively trying to be a stock-picking genius to beat the market. A passive fund, on the other hand, isn't trying to be a hero. It just buys everything in a specific market index, like the S&P 500. Its goal isn't to beat the market. Its goal is to be the market. So which one is better? Well, check out this number, 97%. What is that? That's the percentage of active fund managers who, over a 10-year period, actually failed to beat their simple passive competitors once you factor in fees. 97%. That's a jaw-dropping number. But hold on, because the story isn't that simple. This is a great point from a discussion online. The whole passive always wins idea might not be a universal truth. In a market like India, for example, some argue that there are a lot of really skilled fund managers who do consistently beat the index. It's a powerful reminder that where you're investing really matters. Okay, so this brings up a really good question, right? Yeah, active funds cost more, but aren't you just paying for expertise? Paying for that brilliant manager to make the smart moves for you? Well, let's look at what that expertise actually costs. The average active fund is charging you about 0.40% a year. The average passive fund, more like 0.14%. Now I know that difference looks tiny, but trust me, when you let that compound over 20 or 30 years, it adds up to a staggering amount of money that's leaving your pocket and not staying in your investment. And that fee, the expense ratio, isn't just one thing. It's a whole cocktail of costs. You've got the management fee, marketing fees, account fees. Sometimes you even get hit with a fee just to buy the fund in the first place or to sell it. It's a lot. This analogy I saw online just makes it so clear. Imagine you sell a house. You pay the real estate agent their commission, and that's it. One and done. But with a mutual fund that has a 1% fee, it's like paying that real estate agent their full commission every single year for as long as you own the fund. It just keeps eating away at your money year after year after year. That's how powerful these fees can be. Okay, so we've talked about what not to do, and we've talked about the big choices. So for our last part, let's bring it all home. How do we actually use this info to build a smarter portfolio? Everyone knows diversification is key, right? Don't put all your eggs in one basket. But there's a sneaky trap here called over-diversification, or my favorite term for it, diversification. Smart diversification means adding something genuinely different to your mix. Diversification is when you own like 5 different large-cap growth funds, and they all hold the exact same top 10 tech stocks. You think you're diversified, but you're not. And this happens all the time. Let's say you've got a simple target date fund in your retirement account. Then you read an article about a hot new AI fund and you decide to buy some. The problem is your target date fund is probably already packed with those exact same AI-related tech stocks. So instead of spreading out your risk, you've accidentally doubled down on it. So how do you avoid this? Here's a quick 4-step playbook. First, actually check your holdings. There are free tools online that can show you the overlap between your funds. Second, be strategic. Don't just chase a trend. Ask yourself, does this new fund actually fit with my long-term plan? Third, think add value, not volume. Look for something that brings a new flavor to your portfolio, maybe some international stocks or small-cap funds. And finally, number 4, just monitor and rebalance. Peek under the hood once a year to make sure everything is still on track. Because at the end of the day, that's what this is all about. Successful investing isn't about thrilling, dramatic stock picks. It's about patience, having a plan, and having the discipline to stick with that plan, especially when things get choppy. So I want to leave you with this one question to think about. Go look at your own portfolio. Is it built on a real, thought-out strategy? Or is it kind of just a random collection of whatever funds were popular last year? Seriously, the answer to that question could change everything.